Today, using ValueLine's digital platform and investor tools, I'm going to show you how to quickly and easily find worthwhile investment candidates. Going further, I'm going to recommend one small cap stock to buy right now. After the presentation, we have allotted time for questions and answers. To start, for those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including the 1,700 that are included in this service. ValueLine does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. As part of the formal presentation, I thought it worthwhile to include an overview of the economic situation, as well as the ValueLine Research Department's view of the stock market. Obviously, this could help us get an idea of which small cap stocks to target. The following content was prepared by Harvey Katz, ValueLine's chief economist. The second half economy may not be as strong as we had expected. To wit, after a reassuring 3% rise in GDP in the April to June period and encouraging early third quarter metrics, the nation had seen positioned for a similarly impressive final 6 months. But two devastating hurricanes, a dip in retail sales, and declining industrial production have changed the outlook. Indeed, we now think growth will be closer to 2% in the third quarter and just a bit more than that in the concluding period. A better 2018 is likely, as the year should see some pent-up consumer demand unleashed. We also expect much of the output lost during the hurricanes to be made up as reconstruction begins. Further, it's still possible administration-backed infrastructure programs and tax reform will be adopted. So, assuming the weather is less of a factor and the backdrop in Washington turns a little more bipartisan, GDP growth could approach 3% next year. Meanwhile, the Federal Reserve is holding fast. Although a marked jump in August consumer price index did raise some flags, most longer-term inflation expectations remain low. And when coupled with the aforementioned likely shortfall in GDP growth this half, the scales were clearly tipped against raising interest rates at the recent FOMC meeting. Meantime, in another move, the Fed noted it soon will begin unwinding its stimulus program. Next up for investors will be third quarter earnings season, which will kick into gear shortly. Expectations are for more modest gains as Wall Street strives to sustain its high PE multiples. Recent profit performances have been strong, which has helped extend this historic bull market run. In fact, the records continue to fall on Wall Street, with September having brought a series of all-time highs for the Dow, the S&P 500, and the NASDAQ. Earnings season, if positive, should help keep the bullish fire alive as we head down the stretch in 2017. That is, unless geopolitical events throw Wall Street a curve and cause that flame to flicker for a time. In conclusion, the fundamentals are supportive and additional records could well be set. However, the road to higher equity prices may not be smooth given these extended levels. Now for the core presentation. As you can see, I am now at our homepage, www.valueline.com. On this page, free of charge, you can access daily market commentaries, as well as general interest articles that are written by our analysts. Examples of such content are analysis of economic releases and quarterly earnings supplementary reports on the 30 components of the Dow Jones Industrial Average. I am now going to sign in with my username and password. After entering my credentials, I am taken to the welcome screen. From here, I can quickly get to many important areas of our website, including Browse Research, which is the main home for our core equities products. I can also head to our investor tools, as well as the homepage for our monthly stock selection services. That said, for this presentation, I want to start at the dashboard, which is the main landing page for subscribers. As Harvey Katz mentioned in the market commentary, the fundamentals are supportive and additional records could well be set. However, the road to higher equity prices may not be smooth given these extended levels. I personally believe that this is a logical view, especially in this market. On that note, let's take a look at how the 1,700 stocks in the Value Line Investment Survey are being valued at this time. To do this, the weekly summary index is a good place to start. This 40-page PDF can be accessed via the quick links. As you can see in the box on the left in the middle of the page, the median stock in our universe is trading at more than 19 times our 12-month share earnings estimate to March 2018. This is a good time to mention that Value Line's estimates are created completely in-house by our research team. Our PE calculation is also different than many other research houses. More specifically, we use a combination of reported figures and estimates for our PE ratios, which we think is better than using a trailing figure or just estimates. The PE of 19.4 on a historic basis is a bit high, but is consistent with levels reached during other multi-year bull markets. For perspective, let's consider just how far we have come. The S&P 500 index is now valued at around 2,500. 5 years ago today, it was around 1,460. That is a gain of more than 70%. We think there are still plenty of worthwhile investment candidates, but at these levels, there are surely overvalued stocks, so it is vital that we separate the good from the bad. For our search, I'm going to consider price to earnings, as well as other important metrics. Let's now go to the screener and find some small cap candidates. This important investment tool can be accessed via the Find Ideas tab. Subscribers have access to more than a dozen preset screens, as well as more than 40 fields. I should also note that the screener possesses more than 200 fields in total, but those are only available with a higher level subscription. I am now going to run a screen. First off, as I mentioned at the beginning, I'm going to focus my search on small cap stocks, which Value Line defines as those with market capitalizations of less than $1 billion. Just an FYI, we consider mid caps to be $1 billion to $5 billion, and large caps to be greater than $5 billion. Small caps typically hold greater top and bottom line growth prospects than their larger cap rivals, since these companies are starting from a lower base. So naturally, let's start with market cap in the screener. As you can see, you just simply click on the field, and it comes up. To adjust the range, this can be done in a couple ways. You can use the sliding bar, or just type the values in. So for the 2, I'm going to make this 1 billion. Please note that the field's in millions, so 1,000 is 1 billion. And let's click on filter. Okay, we have 3,600 or so results. Since we discussed it earlier, and it is important, let's include price to earnings. As mentioned, the median is 19.4, so I'm going to focus on stocks that are currently trading below that level. I also want to remove stocks that are trading at very low multiples, which often implies that something, besides earnings, is impacting the stock. That can be a legal matter, recent management turmoil, or signify an industry that is currently out of favor. Thus, I'm going to set the lower bound to 5. Mr. Katz stated that the road to higher equity prices may not be smooth given these extended levels. Let's assume this to be correct. Thus, I think most of you would agree that selecting more stable issues would be a good idea. To target relatively steady stocks, most investors turn to beta, which is certainly valid and reasonable. However, instead, I'm going to use Value Line's proprietary price stability score. Stock price stability is based on a relative ranking of the standard deviation, which is a volatility measure, of weekly percent changes in the price of a company's own stock over the last 5 years. Stocks with ranks of 100 represent the most stable, while those with a mark of 5 are the least stable. Notably, price stability is one of the 2 factors, the other being a company's financial strength rating, that determine a stock's safety rank. Before we assign values, please note that we are looking at small cap stocks. They tend to be more volatile than more established, larger companies, so I'm going to be generous here. Let's set the lower bound to 50, which will remove all stocks that have below average scores. All right, 175 results. We're making some progress, but that is still far too many. Since we're focusing on small caps, and I mentioned earlier that they tend to grow faster than larger companies, let's make sure. Value Line's research department creates 3 to 5 year projections for company financials, including revenues, earnings, book value, dividends, etc. These projections provide a long-term view in regard to where we think a company is heading. For this exercise, I'm going to focus on earnings per share growth, and unlike price stability, I'm going to have rather lofty expectations. Let's set the lower bound to 10%, and this will assuredly knock our number down to a manageable list. There you go, 5 results. Any and all of these may well fit in an equity portfolio that desires small cap exposure but wants to balance risk and growth. Before I move on, please note that users can save screens and revisit them later by utilizing the button at the top. If you are like me, you tend to watch a batch of stocks for a few days or weeks before seriously considering taking a position. Value Line's watch list tool makes this easy. I can access the watch list with the link above, or from Browse Research, which I'm going to do now. To save time, I have already created the watch list for these stocks, but the process is quick and easy. A quick glance at the 5 stocks, and you may notice that several of them are trading well below their 3 to 5 year target price ranges, suggesting ample appreciation potential. That said, you may have also observed that 4 of the 5 have performed poorly of late, and that appreciation potential is really recovery potential. Of these stocks, I am recommending a closer look at Knoll Inc., ticker KNL. In fact, in my opinion, it is one small cap stock to buy right now. Let's see why. Clicking on the company name will take us to the equity's digital report, where the data, information, and analysis is arranged in more than 15 modules or boxes. These modules can be moved around, resized, and hidden so you can create your own customized stock report. For instance, let's say I am most interested in the analyst commentary. I can simply click and drag that box to the top. In addition, now I want to see more rank-related information. For that, I simply click on the larger rectangle in the heading. Once I alter the presentation to my liking, I can save the changes from the sliding horizontal action bar. The next time I come to this stock report, it will look the way I set it up. Let's next get some quick information about Knoll's operations. I'm going to scroll down to the Business Overview module. As you can see, the Pennsylvania headquartered corporation engages in the design and manufacture of furnishings, textiles, and fine leathers for the workplace and the home. The company employs more than 3,400 individuals, and officers/directors own less than 2% of the common stock. Let's now look at Knoll's recent price action, which we already know has been lackluster. From the valuation module, I can quickly pull up a stock chart, and the yellow line is the equity's performance. Sure enough, it has declined over the past several months. In fact, year to date, the stock price has dropped more than 30%. For comparison, the S&P 500 index is up almost 12% over the same time frame. I am now going to take a look at the analyst commentary to get some information in regard to why Knoll has materially underperformed the broader market of late. Senior analyst Oriental Haibi stated, the stock has fallen over the past few months due to shareholders' concerns surrounding secular and cyclical headwinds, as well as worse than expected second quarter financial results. Specifically, the top and bottom lines declined 9% and 41% respectively from the previous year period. We note tough comparisons due to the timing of large contract wins reported last year. Next, higher steel costs have caused margin pressure. Notably, the gross margin decreased 150 basis points to 37.2% year to year. Finally, the high design furniture maker has battled a challenging marketplace as competitors have discounted prices to mitigate excess inventory and drive sales. Indeed, the core office unit continues to face weak demand. Moreover, there has been a shift in the workplace environment as customers have placed a focus on healthier, more productive work environments. 2, space allocated per individual worker continues to decline. These factors, along with a bit of profit-taking by investors, have prompted this equity's value to stumble. I now want to show you our classic PDF report, which is included with a digital subscription, and provide some analysis on why we think operations will improve and the stock will trade for between $30 and $40 during the 2020-2022 timeframe. Accessing the PDF can be completed via the tab in the gray bar. Going back to Oriental's commentary, emerging industry trends augur well for the top and bottom lines next year and onward. Management is focused on building out its business beyond traditional workspace and storage product offerings as customer demand shifts to higher-priced, adjustable furniture designs. 2, Knoll's efforts to build its sales force and establish modern manufacturing and information technology infrastructure should bolster results. What's more, investments in leaner operations and headcount reduction should support margin growth. As you can see in the statistical array, Value Line is projecting healthy top and bottom line gains over the next several years. You can see that right here. As mentioned, the stock has performed poorly of late, but the bad news appears to already be reflected in the stock price. In fact, Knoll is trading at just over 13 times our 12-month share net estimate to March 2018, which is below its historical average, as well as the multiple we project 3 to 5 years out. As such, we think that patient, speculative investors will be richly rewarded here. Please note, however, that while Knoll did pass our screening requirements, there are still risks present. Before making any investment decision, as always, we strongly suggest that our subscribers carefully peruse our full report for more information and weigh their individual risk tolerances and goals. Another useful tool that is available to Value Line subscribers is the Alerts Hub, which can also be accessed via Find Ideas. Users can set up alert notifications and receive an email or text message when a notable event occurs for a specific stock. You can set up alerts for a variety of events, including when the price of a stock moves considerably, when there is a trading volume spike, or when Value Line changes the rank of a particular stock. In total, more than 15 alert functions are present. Let's quickly set up an alert for Knoll. For instance, after participating in this webinar, you are interested in the stock. However, perhaps you want to follow it for a little while and want more information before establishing a position. You can set up an alert and get notified when Value Line puts out a new report on this issue. I will take you through this easy process now. Simply click on Add Alert, type in the ticker, select the result. as you'll see, you'll get the recent price as well as our range and the daily volume. For analyst updates, you come right over here. You want to know when a new research report is available. Select your email address, or you can put in your phone number to receive a text message, and add the alert. And as you can see, it goes right in here to my list. You can update this or cancel it at any time. I hope you found the method for finding a stock to buy right now interesting, informative, and efficient. I do also want to point out, however, that Value Line offers a variety of model portfolios that can help alleviate the work of finding worthwhile investment candidates altogether. Part of the Value Line Investment Survey is the weekly Selection and Opinion newsletter. Along with economic and stock market commentary are 4 model portfolios. Each one is a different investment strategy, is actively managed, updated each week, and always contains 20 stocks. The portfolios are overseen by senior research analysts. Let's go take a look at that now. That's also in the quick links. Portfolio 1 is best suited for aggressive investors and focuses on stocks that are expected to outperform the broader market over the year ahead. Portfolio 2 should be of interest to more conservative investors and focuses on dividend-paying stocks that also offer worthwhile appreciation potential. Portfolio 3 chooses equities with long-term price growth potential and, of course, is best suited for patient investors. Portfolio 4 is filled with stocks that possess above-average dividend yields and is for investors seeking current income. We have a great number of subscribers that follow these portfolios. For those interested in possibly adopting one of these strategies, here are a few helpful details. New positions always amount to 5% of the market value of the respective portfolio at the time of the trade. Any dividends received are simply taken as cash. They are not reinvested. Lastly, the portfolios are not rebalanced. Let me just quickly take you through how the tables are set up. And as you can see, there's a corresponding write-up each week. All told, the model portfolios represent some of the Value Line Research Department's best investing ideas, and we recommend that you read the analyst-created content and look over the portfolios for possible additions to your holdings. Subscribers looking for a total investing solution are also encouraged to check out our premium monthly selection services, Value Line Select, Dividend Income and Growth, Special Situations, and Select ETFs. If this is something that sounds up your alley, call 1-800-VALUE-LINE for a free sample report. This marks the end of our formal presentation, and I will now tackle your questions. Hold on one second. Let me just pull up the questions. Okay, a question about Noel. What is the ranking? Why don't we go back to the report, PDF I have right here. Presently, it is ranked 3 for timeliness, which is in the middle. It's an average selection. It's also a 3 for safety, which is average. That's to be expected for a smaller cap stock. What other questions do we have? Okay. When will Value Line cover Dow DuPont? Okay, that's a common question we've been getting the last few weeks. As most of you probably know, 2 very large companies, Dow and DuPont, merged a few weeks ago. DuPont was obviously in the Dow at the time, and now this combined entity remains in that group of 30. We are preparing our initial report now for Dow DuPont, and that will be on our website come Monday. Next question. Can I screen for stocks in a timely industry? Yes. Not only is that in our summary index, but let's go to the screener. In the preset screens at the bottom, I almost didn't see it there, timely stocks and timely industries, and that will pull up that list. Next question. This is actually about the ranking. Why not focus on VLs 1 and 2s in your screening? I thought 3s are really holds. Obviously, we prefer stocks to be 1 and 2, but that is just one metric. Just like anything else, I wouldn't recommend just relying on one rank, one PE, one dividend yield. I like to look at a lot of different things. Noel passed my requirements for a lot of other variables, so I thought it was worth highlighting. All right, next question. Does Value Line use GAAP or non-GAAP in their analysis? This is another question we get a lot. We try to use GAAP whenever possible, although we always adjust for non-recurring gains or losses, discontinued operations, and special items. Each stock is looked at individually, and our analysts make a determination. This is why figures often don't match when you look at our reports versus an SEC document or a report by another research house. Okay, next question. Does Value Line provide sell recommendations? Yes. In the Value Line investment survey, in our commentary, the analysts will often mention to take profits or not to buy a stock. Going back to the ranks question, a lot of users look at a 4 and a 5, and if they own a stock, especially when it hits 5, they'll often sell. In the model portfolios I mentioned, in the write-ups and in the corresponding tables, it also mentions what the trades were that week if there was a sell, and of course, there's always 20 holdings, so there's a corresponding buy. We also put out sells, actually, this is where we really feature it, in the select offerings. Those products recommend at least one stock every month for purchase, and periodically we recommend selling a stock. And when that happens, all subscribers to those products receive either a phone message or an email immediately alerting them of the sell. Next question. Does Value Line track PEG ratios as a value measure? As analysts, we do look at that, but that metric does not appear on our reports. Let me see if there's any other questions. Bear with me. I just don't want to make sure I don't miss one. No, that is all the questions we have. Thank you so much for the ones that sent those in. This marks the end of the presentation. Thank you very much. Take care.